November jobs report saw blowout numbers Friday with the unemployment rate falling to 3.5%. But even with that strong economic data, issues like the trade war and low interest rates have clouded investor sentiment with recession fears. Our next guest, who doesn't really need to come on today, says that may finally be coming to an end. Joining us now, Jim Paulsen, chief investment strategist at Leuthold. We'll get it right from the horse's mouth. Did it get back to you, or were you watching when I was, talking all about you on Friday?
I just heard a little bit, I think, of it, Joe, after I
Pays
sent
to
you
watch,
the note.
doesn't it, Jim? Or normally would pay to be tuned in, even if it's just in the background. Anyway, you sent that to me that even though we haven't emerged from a recession, because there was no recession, right, that it almost feels, or at least there were certain aspects of our mood for the past 6 months. There was enough of a concern about a slowdown that number on Friday was like one of the first numbers that dispels a recession.
Yeah, I think we had the almost 20% collapse in the stock market last year. Then the world economy slowed down. Then we had bond yields collapse into negative territory. Then we had an inverted yield curve. We still had the trade war going on. We passed the anniversary for the longest recovery ever in U.S. history. And that combined to just create a sense in most people's minds that we were in recession or imminently headed for one. I think those recession fears peaked in August. I just don't remember another time when we've had that strong a recession fears. And the behaviors, Joe, were very recessionary. I mean, we were led by all the defensive assets like gold and safe haven dollar and bonds and defensive sectors and low vol investing. And even though the market was going up, it was led by bearish assets, if you will. So then the data started getting a little better there in the summer, and people still doubted it. They doubt that the stimulus of policy officials was going to work. That just sounds a lot like coming out of past recessions when everyone is very doubtful it's going to work. And then we get a blowout jobs number, and you had the stocks going up even though yields were going up. It just felt like finally exiting a recession. We'll have to wait and see if that's the case, if we move towards more optimism next year. But it sure feels like you're coming out of a year of recession fear.
You can just see it in some of the numbers in terms of $135 billion being pulled out of U.S. stock-focused mutual funds and ETFs so far this year, which you would think, if you didn't do the good news is bad news, you would think that was a bad thing. But Journal goes on to say the outflows are a sign that investors aren't chasing the stock market and the strong performance, and it suggests that the major indexes have plenty of room to run, even though it's been a fairly long rally. And I think that plays into what you're saying, the sentiment.
I agree. There's a number of oddly good things right now, Joe, that we just 11-year-old recovery shouldn't have. And I'll just throw out a few of them here. Productivity's picked up in the last few years. It's almost more than 2 times greater than it was in the first 6 years of this recovery. If you're at full employment, what's the one thing you need? You need a recovery extender, and we got it with a pickup in productivity over the last 3 years now, about 1.5% per annum. Labor force participation rate, you talked about Friday, is now rising. So the unemployment rate's only fallen by 0.2% in the last year, even though job creation's up about 1.4%. And the difference is we've had a 1% increase in the labor force participation rate, which is just a gift this late in the cycle. We're having a surge in household formations in the United States because millennials are finally getting married as they age, their average age goes over 30, and forming households. That's a huge positive for growth. We've got this huge chunk of the economy, the manufacturing sector, we've thoroughly recessed, and we can now recover it again, have the privilege of reviving a big part of our economy. And then to your point, we still have a wall of worrywarts. The only difference right now is they're armed with a wall of cash, and they're woefully under allocated to risk assets. So if it does continue, this recovery, there's a lot of portfolios that are going to have to up their risk asset exposures, which could drive stock market values and other values higher.